Welcome back to the Global Goals Studio, where we're talking about ESG investing. Question for you, Meghan Starr, from the private equity perspective. How do you and Carlyle view ESG factors in your investment considerations? And how has that changed over the past half decade or so?
Thanks for having me. So the conversation around ESG data and ESG metrics is really interesting. I think sometimes, frankly, it can be a bit of a red herring because ESG data is a piece of the puzzle, but it's not the answer. And so I think if we treat it as a binary, these are good ESG companies and these are bad ESG companies, that doesn't reflect the investing world that we're confronting today. And so we've been really focused on this concept of change over time. And so how do you accurately measure progress? And progress that's convergent with financial profitability. One of the interesting things about private equity is we have very granular financial data across our portfolio companies. As we can tie that with very granular ESG data, we actually can start to see where those two converge. So for example, in our own portfolio, our companies that have at least two diverse board directors have about 12% faster annualized earnings growth. And each additional diverse director is correlated with a 5% increase. And so where we're able to really prove out those correlations, that's where we can focus on change over time in a way that's accretive financially. Much to Karen's point, we've been really focused on ESG-linked financings because it's another way where we can financially incentivize company progress on issues as opposed to trying to divide them between good companies and bad companies, which I think is kind of a false binary. We just did a billion euro loan, for Flender, which is a carve out we did from Siemens that manufactures wind turbine gearboxes. And that €1 billion loan, you can achieve almost a 10 basis point discount by hitting ESG metrics over the duration of the loan. And so again, it's this idea of how do we think about it as change over time as opposed to static state. And then the last thing I would say is that I think we have framework fatigue as an industry. And I think in 2021, convergence is the name of the game. We do not need another framework. We need a critical mass of companies that disclose the same performance-based comparable data. We really applaud the efforts of the WEF this past week in getting companies to disclose the same data in public markets. I actually think private markets can be a real force for change here because we tend to control a critical mass of companies in our portfolio. And so I'm curious in 2021 about what private equity can do to be a force for convergence of collecting that data in a standardized way across our portfolios.
That's a great point. Richard Mattison, the critics unkindly have said ESG metrics are just some sort of evolution of greenwashing. What role do you think the ratings agencies have to play in making ESG metrics as strong as credit ratings, for instance?
Yeah, I think the first point to make is that, on behalf of S&P Global, I think we are integrating a lot of information on ESG into a lot of different things that we're doing. So, for example, over the last 8 months, 2,300 credit ratings have been influenced by ESG with 900 downgrades that have been influenced by ESG. So there is a lot of ESG information we're already using. We've got over 600 billion data points on climate risk, for example. And when we analyze the S&P 500, you can see that about 60% of the S&P 500 have assets at high risk of the physical impacts of climate change. What I think is lacking is, to touch on a point that Meghan made, is that I do actually think that we need some convergence of standards so that we have widespread reporting of common things on ESG. I think that is kind of lacking at the moment. We do applaud the WEF and the IBC's efforts to do that. And I think that's a great effort. But I think there's 3 points here. One, we actually need a minimum threshold for ESG indicators, a simple short list, which is why we applaud the efforts of the IBC and the WEF, because really we believe that pretty much every company in the world should be able to report on a core list of ESG indicators. Anyone from a very large multi-billion-dollar company all the way through to a very small supply chain company in a different part of the world. And that is important because we need that flow of information to direct capital towards sustainable outcomes. But in terms of convergence, we also need convergence around sector-specific indicators that, the larger companies should be able to report on. And finally, we would say, actually, we need the digitization of information on ESG so that we can actually, enhance the flow of information to the market so that we can achieve and direct capital towards more sustainable outcomes.
Those are brilliant points. And we can't really do the subject justice, but I want to thank you all for giving us this enlightening insight into this conversation. Thank you to Richard Mattison. Thank you to Jim Pass, Meghan Starr, and Karen Fang as well from Bank of America. Thank you to you all. Please stay with us. You're watching the Global Gold Studio.